Welcome back, everybody. Today I'm talking about a strategy that was brought to my attention by a member of our Discord community, and it's very unique in the fact that it has a set of rules that you follow, and you don't really have to make decisions, so it becomes a monthly passive income thing that you can do, and it requires less capital than you might normally need in order to retire. So on the surface, it sounds really good, and we're going to go ahead and talk about that strategy, and then we're going to actually do a big back test going back 2 years to see how the strategy holds up over time, because I think that's just an important thing to do, especially if you're going to be putting your life savings on a strategy like this. So if you like this content, go ahead and subscribe and then turn on notifications so you can stay up to date. So something that drives me nuts are these articles about how much you need to retire. And if you just do a quick Google search, you can see that there's a lot of fear being put into the public eye that you need like $2 million to retire. And I simply don't think that's true. Like, here's a study or a case study that says that $2 million is not enough. Again, we're spreading fear, and that's a lot of money. And when I was approached with this idea of using a smaller amount of capital to fund your retirement using option strategies, I just had to look into it because I don't think anyone needs $2 million to retire. It should be a lot less than that. It's just a matter of figuring out how much your expenses are that you expect in retirement and then multiply that by 25. And that should be your target number to retire if you do the 4% withdrawal rule. But if you're using options, you might even get a little smaller than that. But the goal is to find a strategy that you can do with options in order to reduce that number and take off risk while doing it. So now the strategy that I was told about was to do the wheel strategy or the triple income strategy on SPY. Now what's good about doing it on SPY is you're doing it on a pretty large index. So any one individual company going under is not going to kill your portfolio. You need a major black swan event to happen, and even then you might come out okay. And that's actually why I chose to go 2 years back for this back test, so that we do capture that March dip to see how the strategy holds up over time. And basically, for those of you that are not familiar with the wheel, what we're doing is going to be selling puts at the money on SPY a month out, collect that theta decay, and then if you're assigned the puts, you go ahead and you turn around and you sell calls. Now, you've probably seen this picture before if you've been watching my videos, and you start with selling this cash secured put. If it expires out of the money, congratulations, you made money, sell a new put. If it expired in the money, then you go and you sell the covered call, and then congratulations, you're back here. That's the very simple process of the wheel, and that's why this was an interesting idea. Now, the person told me that the guy was claiming that you can make like $1,300 per contract every month doing this on SPY. And it's true right now. If the volatility stays where it is, it's pretty nice. Starting out this strategy, what you would do is you would sell a put and sell a put at the money. So that'd be 442 right now. And the premium you would collect per contract is $11.52. So if you're doing this with your whole account and you have $250,000, you can divide this to figure out how many contracts you could do. Since this is at 442, we're saying we will buy 100 shares at 442, which is $44,200. So if we divide by that, you can see we could put on 5 contracts because you can't do partial contracts. So what's 5 times 11.52? 57.6. But remember, this is times 100 because you're doing options. And that means you would generate almost $6,000 in income if you do this right now, selling a put a month out on SPY with a $250K portfolio. And that's a lot of money. What was that, $72,000 per year? I'm sure a lot of us can retire on that, and that's with only $250K in your account. Now, the beauty about this strategy is that it's a no-think strategy. So in a month, if SPY is below 442 and you get put the shares, you just turn around and you sell a call at the money on your shares. And that's why this strategy kind of like stands out, because no thinking, it's just automatic kind of thing. And you have to switch to like a more of an income mindset, I think, to make this strategy make sense, because you will be selling calls below your assigned price at times. But as long as SPY continues to trend down while your account trends down, you're still selling the same amount of contracts. Theoretically, you'll be making the same amount of income. And So this is so different from what we're used to talking about, I did want to backtest this. And if you know how the wheel options work, go ahead and skip to that chapter and just go look at the backtest, because I'm going to start talking about how this entire thing works with puts and calls and how to run the wheel. So if you're familiar with that, go ahead and skip forward. If not, stick around. So anyway, if you were assigned those shares at 442, you turn around, you sell a call. It's a covered call at this point, and you do it out of the money. So 443, and again, you'd have 500 shares, so you could sell 5 of these, and you make $5,840 because you'd be selling 5 of these. And you make about $5,400 for that month because you'd have 5 contracts up at 1084. Now, the reason I didn't go out to March here is because of the way options work. You'd have more time value, so you see an inflated number if I was to actually go out to March. But that's the date you'd be going out to, and the premium would be a lot less because there'd be a month less of theta decay. So right now it would show 1550s of 1082, I think it was. All right, so the wheel strategy is pretty simple. It's just a series of actions you take depending on what happens. And you can even print off this picture here if you want to. But you start by selling a cash secured put. So when you're doing that, go ahead and jump back to February 28th. You make sure you click sell and then put. And this is where you would click to put in your order. And what you're saying when you're doing this is that you will buy 100 shares at that strike price by that date if the buyer wants you to do it. And since you're doing this with all the cash in your account, it's a cash secure put because you can actually take assignment of those contracts and own those shares. So this is the put side of that. For doing this, the person who bought this option is paying you $1,191 so that they could unload their shares onto you if SPY drops down. So since the market is a zero-sum game, whenever somebody wins big, someone is losing big. And usually when you hear stories about options, it's mostly people buying options, trying to get rich quick. And people gravitate towards that because they don't have the capital in order to sell options. It's a lot more enticing to buy options because they cost so little and you can make so much more money. But if you're selling options, you're collecting all those lottery plays, basically, and that just goes right into your pocket. And if you can sell options, you can choose what percent chance you'd be correct. And we could have 70, 80, 90% chance of being correct, where someone buying the option might have 5, 10, 15% chance of winning. And they need a significant move to win. While if the stock trades flat, if you're selling the options, you win because you have theta or time decay working in your favor. So that's why this is really cool. It's because you're selling options. It's a selling option strategy. And if you've been watching my channel, you've seen I've made so much money off selling options. It's mind-blowing. Anyway, back to the wheel. After you take these shares, like what happens if SPY stays above 443, you don't have to buy the shares. You keep this $1,190 that they paid you per contract. That's income in your pocket. Like they never get that back. And if it stays above 443, you're not going to be buying shares either. So you just made this promise to buy the shares. They gave you money for it. And now you're like, you know what? Promise is done. Thank you for the money. If it goes in here, your break even is actually lower than this price that you're assigned at. So you have 443, but you collected $11.91. So you subtract that, and then your break even would be $432 about, give or take. And what you do is you take the strike price that you had and subtract the premium that you received, because that's cash that you've received automatically. So even if you get assigned at 443, you might still be in a profitable position. Like if SPY only went down to 440, so you lost $400 on the shares, but you made another $700 profit from the put that you sold. Now, if you get assigned these puts and you have the shares, the next month rotation, you're going to be selling the covered call. So make sure you're on sell and call. And then again, you're going to be selling at the money, one out. So 443 be worth $1,000 and $1,084 per contract. Now, in the case of the 250K portfolio, you have 5, so that's $5,000. Now, what this is saying is you're agreeing to sell 100 shares at 443, and for doing this, someone's going to pay you $1,084. If SPY stays below 443, you keep your shares and you keep the money that they gave you. Again, they just paid you to lock in a price that they might be able to use in the future. So like if SPY shot up to 600, you miss out on all that gain, they get that gain, but you still get this profit because you collected that 1,084. And in this case, we were assigned at 443, so we're just giving the shares back and we collected more premium, more money in our pocket. And that's the allure of this strategy. You can run the wheel on any particular stock that you want, and you can even sell covered calls against your dividend holdings if you want to, for some extra income. And that would actually outpace your dividends if you do it correctly. And you can sell that at 95% chance of being right too, which is pretty cool. But eventually what you're going to do in this strategy is eventually your shares will get called away, and then you just go back to selling puts again. So it's just an automatic process. You're just following the flow chart that I showed already like 3 times. And it's just automatic decision-making tree that you would just do. So with all this said, if you have any questions about the wheel, go ahead and leave a comment. I made some videos before about it, and I'll try to see if I can find the link and put it into this video. But leave comments and questions. I'd love to answer them. But let's go ahead and start looking at that back test, because that's very important to see. Because some of the question marks I have about this strategy is the fact that it's presented as though you can always collect $1,200 for doing an at-the-money contract on SPY. And I think that's not going to be the case because VIX is very high right now, so premium is inflated. This is not going to be the average that you get filled at when VIX returns back to the norm. And then the other thing is SPY has changed drastically in price over the course of the 2 years. And something I'm worried about with this strategy would be that you get assigned puts, or you get put shares at a price, and then SPY jumps up after you sell your covered calls, and you miss out on that appreciation. So you're locking in a loss on your shares, which will reduce your account portfolio size. And I'll be interested to see how that plays out over time using this strategy. And we could try it with some different account sizes, as well as try to alter these strategies slightly to see if we can make a more profitable version. So let's go ahead and jump into that back test now. All right, so in order to back test this, I went to Thinkorswim. I used the on-demand feature. If you don't know how to use this, learn it because it's awesome. I made a video about this. I'll put a link right here. Anyway, once you go in here, what I ended up doing was I switched the date to the day that I'd be selling the option contract. And then once this loads, and sometimes it does take a little bit of time to do, I went to the Analyze tab, went to the date of expiration of where I'd be selling the put contract for. So what I did for this is I always sold the contract that had the last date of expiration for the month. So we consistently had that 30-day window to calculate. So an example, the first one would be is I went and sold the January 29th at the money put, because that was the instructions that was laid out, is you sell the put first, and then eventually you sell a call when we get put. And so this is how I got the premium that we received. And right off the get-go here, you can see we're not averaging $1,200 per contract. But that was actually shocking to me how low that actually was. But you gotta remember, this is pre-pandemic. This is before that March Madness dip happened. This might be the normal premium that you receive once everything goes back to normal. And that might be a couple of years, but eventually we may regress towards these premiums for at-the-money puts on SPY. So that's kind of a red flag to start with. But I went ahead anyway and did the back test just to see what would happen, because I was curious. So then here's the spreadsheet I did. I started by filling out all the cells in this side, just going through selling a put, selling a call when required, tracking how much you would lose per shares when you were selling at-the-money calls and SPY went up and blew through your stuff. And it took some time to get all this, because you saw that on-demand takes a little bit to buffer and load everything up. But you can see that the premium varied drastically ever since the March area here. Premium jumped up because volatility increased, and it's kind of stayed up there since then, which is pretty nice in terms of the strategy. But before that happened, the premium they were getting for selling at the money puts was actually very minimal. And so that's just something I didn't like to see to begin with. Now, the reason why I chose two years back is because I wanted to catch that data point of what would happen in a black swan event, because I felt like that would be one of the stressors on this strategy. So I want to see how to react during that time. And if you were just running like one contract, you would have lost $7,700 from selling at the money calls that got blown by when SPY did like a V-shaped recovery very quickly. And that's kind of the issue with this is anytime you get signed puts, you lose money in your portfolio value when you sell the at the money call because you're doing it at the money and not above your cost basis. So you're locking in a net loss that'll stay in your account forever, essentially. Interesting enough, like the last one I put on, where I had to do a call, I actually was selling at a strike higher than my assigned price, and that's because SPY moved after market the day before, or moved pre-market that day of. So when I was selling the call, it was actually slightly above my assigned price, so that was kind of neat that we made $200 there. Now, yes, you can go ahead and think about adjusting your strategy. Maybe you only sell calls on the stock you're assigned above your strike price so that you don't run into this negative account issue with your balance. And that might be something worth testing in the future. But the way the strategy was laid out is you just do at the money every time, no matter what. So that's why this is in here. And something I thought was interesting is even though we're selling at the money every time, we were only in the money 8 times when these all came out to expiration. Now, we also had a very good bull market during this time period, so the puts majority of the time expired worthless. So I think that's why we have like a 66% chance of it expiring out of the money. So we had 8 that expired in the money, 16 that did not. Now over here, we can actually see what happens with your portfolio over time. You can also see the income that you got. And in this example, we're showing what happens if you use the income. You pull out the income completely no matter what happens. I made an altered version where you reinvest 50% of your income, and we can compare results with that too. Now, first off, with $250,000, we're able to start with 7 contracts. And what I was curious to see is how, over time, could you still sell 7 contracts, even though your portfolio might be going down due to the whole call thing. And let me tell you, that March dip, that really hurt right at the beginning of this. And, I mean, it's potentially an outlier, but who knows? There could always be another giant dip like that, and if the V-shaped recovery. So I can't just throw that data point out and call this a successful test. So I had to leave that in. But yeah, that drastically hurt the strategy right off the get-go. And you can see we're already down to only being able to sell 6 contracts. And another time that we got assigned on our puts, we had to sell a cover call, and we lost out on $10,000. So overall, our portfolio is just kind of going down. And by the end of 2 years, we lost $72,000 in our portfolio. It means we almost lost 30% of our portfolio value in order to generate $92,000 in income. So yes, we did generate the income that we wanted to, almost $50K per year, which is good. But we did that at the cost of our net value going down drastically. And if you take away the taxes, because this is taxable income now, like, you would have just been better off putting this in a savings account and withdrawing from that. So that's kind of disappointing how that happened. But that doesn't mean that the strategy is complete BS. Just, we can't just do an automated sell at the money, buy at the money. We got to play those percentages a little bit. Maybe you could tweak the strategy to make it a little better. The $500,000 portfolio went from $500,000 down to $348,000. So it lost $151K, and it made $193,000 over the course of 2 years. I mean, that's plenty of money to retire on, but at the same time, you're losing like 30% of your value rather quickly. And again, similar thing happened with the $1 million portfolio. lost a big chunk of money here, 300,000, but we also made 400,000. Now, something you can consider doing is, well, over here, what if we only needed 50K income per year? We could have reinvested that $300,000, and now all of a sudden this strategy looks like it could be viable. So instead of taking all that income out, you reinvest what's lost over time, and this could pretty much stay at $1 million. But I think that's a lot harder to do at this area, because in order to do that with just 250K, you'd have to be living off like 10,000 per year, and that's kind of rough. So I went ahead and tried a different version, and in this version, I went ahead and said half the premium stays in the account to get reinvested, half the premium comes out as income to live off of for the month. And you can see how much it changes here. It's a lot better. If we didn't have this black swan event here, like it will actually look viable, I would say. But again, I think you still need to like play the percentages a little bit more than doing at the money. Maybe sell 30 delta calls and puts. But with the putting half back in, taking half out, you can see instead of losing 30% of the value over 2 years, we lost about 10%, which is a little bit more palatable. And I think that may be less over time if you don't have any black swan events. But 10%, including the black swan event, that's about a 5% decline. That doesn't, that's pretty close to the 4% withdrawal rule when you withdraw 4%. So there's viability here. But again, to do this, now you're only getting 25K in income. So you have to either utilize more buying power, because like interactive brokers, you might have 6-to-1 buying power. So you could leverage up to the next thing and do 500K potentially if you're okay with that. Or if you start with more money, it looks a lot better in terms of retirement income. For the 500K one, your portfolio only loses 50K, and you get about $55,000 per year in income to live off of. So it becomes a lot more viable. And if we didn't have this March in here, I think this percent that it goes down would be significantly less. So I don't think the strategy as it was presented is viable, but it can be fine-tuned, I feel like, in order to find something that works. And it might be worth looking into some more. If you had $1 million portfolio, again, you lose 100,000, about 10% of your portfolio, just putting 50% in. Like, you don't need to take out 50% every month if you don't need to. And every year was $110,000 in income to live off of. Like, if I only need 50K, then that 124,000 could have went in here, and then my portfolio would be up, and I'm generating the 50K that I needed. So the portfolio wouldn't actually lose value. So it just depends on how much money you actually need from income, and if you can have a larger account. But instead of having to need 2 million, maybe 1 million is that magic number, and maybe this strategy could be tweaked just a little bit. And if you control your expenses and keep it at a amount that makes it work, like, this could be a viable strategy. Just tweak it slightly, if you know what I mean. Something else I thought was interesting was how the contracts differed. So in the first example, you went from being able to sell 7 contracts only to 3. But in the second version, you can still sell 4 contracts. And that's the same with all of these. Like, the amount of contracts you can still sell at the end here, which means that the income you can generate should potentially be higher because you still have more contracts that you can sell. I think the way that the strategy was originally explained is kind of a busted myth. Like, you can't get away with that. But if you can readjust it to reinvest some money or some additional income or something, then I think it does have viability, especially if you do get into a larger amount up here, depending on what your expenses can be. If you can live off of less than 25K per year, then you can do this with 250K. Or if you're okay with using buying power to increase the contracts, then it's definitely viable. But make sure you understand how margin and buying power is impacted and what you need in order to maintain your positions if you're going to go using margin to retire. That wraps up this video, guys. Thanks for watching. I hope you liked it. If you did, go ahead and share it. And I'll see you guys next week.